Bridgewater Associates is one of the largest investment firms in the world with over $120 billion of assets under management. And it was, of course, founded by the very popular and famous stock market investor Ray Dalio, who still serves the company as their senior investor and is leading their investment committee. Well, as is the case in every quarter, Bridgewater just released their 13F report, which shows all the stocks that they purchased in the third quarter. And in today's video, well, we're going to take a look at the 5 largest purchases of those, the 5 largest stocks they purchased in the most recent quarter, and I'm going to give my own opinion on each one of them. I'll rank them from best to worst, and I'll even let you know if I'd consider buying any of these stocks myself too. So it's always a lot of fun when we do these videos. I hope you're all enjoying them, and if you do, please consider subscribing and hitting that like button. Really helps keep my channel alive, and it means a lot to me. Thank you for the support. But with all that said, let's go ahead and jump into this list of 5 stocks Ray Dalio and Bridgewater Associates are buying. All right, now as always, we'll be counting down here from smallest to largest position in the portfolio, with purchase number 5 being a very popular stock in the market, and that is the streaming giant Netflix, ticker symbol NFLX, which was actually a brand new addition to the portfolio this quarter. However, that's after having sold out of it the quarter before that. So a bit of a strange history here with Netflix, but either way, it looks like they built that position right back up, adding about 95,000 shares and worth over $35 million at just slightly over 0.2% of the overall portfolio. Now, when it comes to Netflix, I don't hate the stock, but I also haven't really been a fan of it either. And it's not that I don't like Netflix itself. I actually do think that they have a very attractive business after being essentially the pioneers of at-home video streaming, which to this day they still command by far the most market share in the entire world, even ahead of giants like Amazon, Disney, Warner Brothers, and more. However, the problem that I personally have with it is that Disney exists. If Disney didn't exist, I'd be much more bullish. But with Disney around, I just can't understand why anyone would choose to buy Netflix stock over Disney's, as they have by far more superior brands like Marvel, Star Wars, and all the Disney family content that have pretty much all grown to become household brands at this point, with nothing else really rivaling them in the world, I would say, especially by Netflix, who has practically nothing compared to them in terms of company-owned IPs. And after only recently launching their Disney Plus streaming service, which combined with Hulu and ESPN Plus, they've already amassed a subscriber count that is pretty close to the same amount as Netflix, and it's even been greater in the past too. Yet not only is the stock cheaper, but the company is also much larger and more diversified across theme parks, resorts, cruises, movie studios, games, toys, collectibles, and lots of other types of revenue streams that Netflix just really has almost zero presence in, which is why Disney does more than double the sales than Netflix does. Yet the valuation is actually less than half based on price to sales, and still close to half based on price to earnings as well. And while Netflix stock has fallen by a large amount from their highs, it's already recovered by over 60% just this year alone. So I just can't really bring myself to touch this one when I feel that there really are just such obvious better choices out there like Disney or even Amazon or Apple, who all have at least some presence in streaming but are not entirely dependent on it. I will be nice though, and I'll still rank Netflix in the middle at number 3 for now, because there may be worse choices on this list and I gotta wait to see what else is on it. Well, you know what? Coming in at stock number 4, we actually have a great stock that I also own myself too, and that is Broadcom, ticker symbol AVGO, which I'm very happy to see Bridgewater picking up as well. This was actually another brand new purchase for them at almost $45 million worth of stock in the quarter. And yeah, this one I've been a longtime fan of myself for really their expertise in developing custom semiconductor chips for really other businesses that use them, especially in areas of internet infrastructure like networking, data centers, storage, and much more. Plus, they sell all the software and services that go along with those markets too, including cloud computing and cybersecurity, both of which are in very high demand. And I think those markets will only get much larger in the future. Pretty much everyone knows that at this point. Not to mention, perhaps the biggest emerging market of all that they're involved in with artificial intelligence, which Broadcom also has a large presence in through various platforms like their AI Ops, for example, which delivers insights from analyzing all the data that is used on the infrastructure and applications and networks and customer experiences that Broadcom tends to provide. And while they don't specifically produce chips for AI like maybe the red hot NVIDIA does, there's still many Broadcom chips that can actually support generative AI and other related applications too, which, by the way, their strength in all of these different areas is only going to get bigger now after finally completing their giant acquisition of VMware, which is worth over $60 billion and was for a long time trying to be blocked by regulators because of the future dominance that Broadcom will now hold, as their sales were already rising by nearly 10% this year, but are now set to skyrocket by over 35% next year as well. And perhaps most important of all, according to Fitch Ratings, the acquisition will also raise Broadcom's software sales from just around 20% of total revenue up to around 40% post-merger. Guys, that's huge because Broadcom already had very stable and impressive financials to begin with, but adding even more software revenue is not only going to strengthen their profitability, but it's also going to help decrease some of that volatility that you would typically see in the hardware chips market. As good as all of this news is though, the fact is that Wall Street has unfortunately already seen it coming and has traded up the stock price accordingly, as it has now risen by 75% just this year alone, which has also left the valuation a bit rich, trading significantly higher than the sector on virtually any metric you look at. I mean, you could make the argument that their PEG ratio isn't too bad still, as it's only about 3% higher than the sector because of that strong future growth expected post-merger. But the other issue is that I used to buy this stock for the super attractive dividend, growth-oriented dividend, when it was yielding over 5%. However, today it's fallen down to just less than 2%. And while it still has some of those excellent growth metrics on it, like a double-digit growth history and a whopping 22% growth rate, the fact is that the stock is just overall not as attractive as it used to be, and I've really stopped my buying in it. I still much more prefer it over Netflix though, so I am going to give them a higher ranking at number 2 for now. All right, next up on the list though, we have a stock that I don't think I've ever covered before on the channel, and that is Schlumberger. I'm not sure if I'm pronouncing that right, but it's ticker symbol SLB, which they more than doubled their position on last quarter, adding nearly 700,000 more shares, bringing the total stake in the company up to over $76 million. And if you've never heard of this one, they're actually an oil and gas related company. But rather than being a producer and seller of oil, they actually specialize in the technology and the services that help other companies with those operations. For example, this includes various products and services related to the construction of wells and actual drilling sites, the decarbonization of the processes involved to help lower emissions, and they assist in site planning, scaling up production, and even accelerating their time to market. It's all really interesting work, and I do expect demand to be pretty high for those services well into the future. However, despite not being an actual producer and seller of oil, their financials are still, I would say, they tend to be heavily impacted, at least by the volatility of that industry, with both 2019 and 2020 seeing significant losses on the bottom line. However, on the bright side, things do look to be dramatically improving in the coming years, with double-digit revenue growth expected in each of the next 2 years, while EPS is also set to soar by a whopping close to 30% average over the next 5 years. Plus, the stock price is currently much lower than even the lowest analyst price target. So I admit that it does look pretty attractive at this level. However, I would caution that it's been a pretty bad performer over the years, which even after seeing a strong rebound recently, it's still trading significantly lower than it did an entire decade ago. And the valuation is a bit of a mixed bag too, with higher PEs than the sector, but a much lower PEG ratio thanks to that future EPS growth expected. This is a bit of a hard one to rank here. I kind of like it, but I'm also a little weary of it too, and I think I'd have to do a lot more research on it before I even think about buying the stock. But overall, I think maybe in between Broadcom and Netflix is the best spot for now, as they would at least offer me something uniquely different than what Netflix can. That will, however, leave us now though with the final two stocks of the list, and coming in as the second largest, it's going to be none other than the gigantic beverage behemoth known as Coca-Cola, ticker symbol KO, which they increased their already very large position on by just about 10% last quarter, bringing it up to over $500 million invested in the company. Now, you guys obviously know this one. They're the king of beverages with many iconic brands, including Coca-Cola itself, but also Sprite, Gold Peak Teas, Fanta Soda, Dasani Water, Powerade Sports Drink, Minute Maid Juice, and many more. In the United States alone, for example, they consistently hold almost half of the entire beverage market share. Plus, it's famously owned by the great Warren Buffett, who keeps it as his fourth largest investment at over $22 billion. But should you be investing in KO2? Well, I wouldn't really argue against it. I mean, the stock usually does perform pretty well. There are some bumps here and there, but overall it does tend to break new record highs in most years. And the same can mostly be said about their financials too. Plus, when it comes to dividends, well, they're sort of considered a king of that area as well, as they've already reached dividend king status with over 6 decades of consecutive increases, and it still yields a pretty good amount too, above 3%. And yet, I am still not a buyer myself. And if you want to know why, it's essentially the same reason I don't buy Netflix, because I just feel that there is a clear better option available in the market, and that is PepsiCo, ticker symbol PEP, who not only has a much more diversified business into solid foods too, but they're also larger and nearly double the sales. They have more revenue growth. They have more EPS growth. They have about the same dividend with also dividend king status. And the stock is actually cheaper too with a lower PEG ratio. So while I might be a little biased because I do own PepsiCo stock myself, I still have to be honest about my feelings here and say that I much more prefer it over KO. So I'll rank them accordingly. It's going to go in last place, Coca-Cola is, because they just really don't offer me anything different or even exciting. I mean, at least Netflix I think is a little more exciting, but that's just my opinion. Anyway, guys, that's going to leave us now with the final stock of the list. And coming in at number 1, the largest of the 5 holdings, well, it's actually going to be an ETF, specifically the iShares IEMG ETF, which Bridgewater increased their position on by just about 7% in the quarter, bringing the stake up to over $900 million, with this also being the only stock on the list to make up over 5% of the entire portfolio. Now, when it comes to ETFs, these iShares ones are some of the biggest and most popular out there, as they are actually owned and managed by the giant behemoth BlackRock, with this ETF in particular being one that tracks emerging markets. Now, you guys know that I'm not the biggest fan of ETFs myself, as I just prefer handpicking all of my stocks individually. However, I do acknowledge that ETFs can be very beneficial to beginners, as well as anyone that is looking for some broad exposure to a specific area. And that's what I think this ETF does a great job of, specifically with those emerging international markets like China, Taiwan, South Korea, India, Brazil, and more. Plus, some of the largest holdings are also stocks that I particularly do like myself, including Taiwan Semiconductor, Tencent, Alibaba, and even PDD Holdings, although admittedly those are definitely more on the higher risk side. But still, the broad exposure across more than 2,700 different stocks with so many different sectors and countries does help lower that risk a bit, while the super low expense ratio that is over 80% cheaper than the median of all ETFs, coupled with a decent little dividend of 2.3%, I think makes for a fairly attractive overall package here. Again, I don't usually buy ETFs myself, so it's a bit of a lower interest option for me personally, but I'll still rank them higher than most of these other stocks on the list, as they at least offer me something more unique and different. But there you have it, guys. Our final ranking is basically Broadcom at number 1 with almost nothing else really worth mentioning here. I mean, stocks number 2 to number 5 could really be in almost any order for me because I just really don't ever plan on buying these. I don't think I ever will end up buying any of them. So yeah, overall, not the most exciting quarter for me personally. I'm not a fan of really most of these stocks here except for Broadcom. But you know, a lot of you might actually disagree because I know Netflix and Coca-Cola especially are some very popular stocks to invest in. So let me know down below. Would you make any changes to my ranking? Do you agree or disagree with anything I said today? I'd love to hear your thoughts. But thanks again for stopping by, my friends. I hope you're all doing well. And I will catch you in the next video. Take care, everybody. Bye-bye.